Anyone with a smartphone today has a Wall Street terminal in their pocket. We have instant access to real-time GDP data, corporate PE ratios, and high-frequency algorithms that analyze markets by the millisecond. Yet, despite this mountain of data, the average retail investor consistently underperforms the broader market. The tools are available, but the execution fails. Take a look at this breakdown. According to wealth manager and personal CFO Dheeraj Shetty, investing is 10% math. The remaining 90% is pure temperament. When the market dips, fear takes over, and that temperament slice expands until it swallows the math whole. This psychological struggle is addressed directly in a text written thousands of years ago. The Bhagavad Gita is often read for spiritual guidance, but it functions as a systematic study of the human mind under extreme pressure, precisely what modern behavioral finance attempts to map. The chaotic battlefield of Kurukshetra that the warrior Arjuna faced mirrors the psychological battlefield of modern market volatility. The internal conflict remains identical. To stop losing money to emotional speculation, you have to master the person executing the trades. Every trade begins with the entry. Most modern portfolios are built on pure impulse, buying on social media hype, a fear of missing out, or a random chat tip. The Gita prescribes a specific countermeasure to this called buddhi yoga. This is the discipline of the discerning intellect. Buddhi yoga centers on the ability to separate fact from feeling. In the market, this intellect is applied through fundamental analysis, the process of stripping away hype to find the logical value beneath. A balance sheet provides the objective reality that rumors cannot. But finding a good asset is only the first step. The principle of svadharma, following your own path, requires that your money be aligned with your specific life timeline, whether that's funding a child's education or building a multi-generational legacy. Building a highly aggressive portfolio just because your neighbor did ignores your personal context. When the market turns, you won't have the conviction to hold the asset because the strategy was never yours to begin with. A successful market entry relies entirely on verified data and strict alignment with your personal goals. Then comes phase 2, the hold. After the initial thrill of the purchase, the adrenaline drops. The reality of long-term investing sets in, and it is often overwhelmingly boring. To survive the boredom, you have to lean on karma yoga. This is the discipline of action. For an investor, karma yoga means fixing your attention strictly on the input. You set up a systematic investment plan, a SIP, and you execute that monthly purchase without fail. The second half of this discipline is the absolute detachment from the fruit of that labor. You ignore the daily ticker prices and tune out the fluctuating market value. This leads to abhyasa, or consistent practice. The tedious habit of annually rebalancing your portfolio forces you to buy low and sell high automatically. It is this mechanical process that drives long-term compounding. Generational wealth is built by stripping emotion out of the process and letting the habit do the work. Then the inevitable happens. Phase 3. Your portfolio drops 20% in a single week. The panic is immediate and biological. This is where the ultimate psychological defense mechanism is required, manas control, the mastery of the mind and its cognitive biases. Let's look at how this plays out on a chart. As the asset's value falls, watch these clustered points pull away from the main trend line. This is herd mentality in action, the biological urge to panic sell because the crowd is running for the exits. To counter this, an investor must practice samatva. Notice how this baseline cuts straight through the chaos. That represents equanimity, maintaining the same calm during a catastrophic crash as you do during a bull market rally. But sometimes equanimity isn't enough. If the company's core fundamentals actually fail, if the business model breaks, the math dictates a sale. Firmly, this requires ahankara, or ego control. You execute the objective exit right here, admitting the wrong call and cutting the loss. You move on from a dying asset without letting pride dictate the holding period. Surviving a market crash relies entirely on overriding your primal instincts with these objective frameworks. The entire financial industry is obsessed with chasing alpha, that metric of beating the market and generating excess returns. We often hear that alpha comes from proprietary trading algorithms, insider connections, or flawless market timing. While data and timing matter, the most sustainable source of market outperformance comes from the self-mastery required to actually stick to a plan. By embracing the concept of anitya, the impermanence of all things, you accept that market cycles will always rise and fall. You stop trying to predict the market, and you start using diversification to prepare for it. Finally, wealth requires yajna, or sacrifice. It is the willingness to trade today's impulsive consumption for the guarantee of tomorrow's financial freedom. A market crash can be navigated. A mind prone to panic is the true threat to long-term wealth. When you manage the person in the mirror, the math takes care of itself.